Okay, so what is a VIE? It stands for Variable Interest Entity Structure. Essentially, what it is, it's a structure that allows non-Chinese people to invest in Chinese companies. But you don't own. So what happens is, like, the Chinese company, the structure's in China, and then they have a Hong Kong listing, and then what happens is that they create this entity in the Cayman or somewhere else that relates somehow to the entity in Hong Kong, but it's like a contract essentially. It's a contract where you effectively own, but without owning the underlying businesses. So what it is that you have a right to some profits, but you don't own the business. So if the business goes under, unless the contract states specifically that you have some legal protections, you don't get anything. The big risk that everybody talks about, which I don't see happening, but it's there, right? It's always at the fort, like at the behind the law, is that China could definitely clamp down on this loophole. It's a loophole right now that exists.
But is it a loophole to get around?
Meaning that in China there isn't a law that like allows for this. Right.
Right, but what is the loophole getting around? So why can't?
So the key aspect is that the current regulation in China limits foreign ownership of specific industries to only Chinese ownership. It exists in the U.S. too. Don't get me wrong. Like ports and some other stuff used to be able to own in ports, airports, other ports, railroads. You have to be American to own them, and I think those laws have more or less gone away over time, right? Because some of the ports are now owned by Dubai, and there's other things. But in China, that exists specifically around telecommunications, and many internet companies, cybersecurity companies. There's a lot of industries that are not that cannot have foreign ownership, and so Chinese companies need capital. And they will try to get the cheapest capital available, and the cheapest capital available is global, right? So you might have an investor that's willing to sacrifice more returns in Sweden, and another person in, I don't know, in Italy, and then another person in the US. If you only limit your ownership to one country, you might not get those people who are willing to not have high returns. And so as a result, your stock is probably going to be traded at a discount to what other companies in the world are. And so to avoid that, Chinese companies wanted to get capital around the world, and so they created these structures. The problem with these structures is that they might not have the same voting rights. They might not have the same residual returns after a company, let's say in the US, a company decides to liquidate. First you pay down your debts, and then the equity shareholders get the remaining amount of money. All these rights that the typical shareholder has doesn't exist in the variable interest entities. It could or could not. Like, you just have to read the language. And I think most people who are investors in these securities don't read those. Like, they're not going to read the contracts. And so, as a result, I'm not sure if I'm a retail investor. I'm not sure I would invest in. I don't think I would invest in variable interest entities. You don't have the same legal protections.
I think it's clear that they don't represent economic interest in the same way that U.S. stocks or developed market stocks do. Like, that part is clear. But my pushback on that
you have to understand that this is designed to circumvent Chinese legislation. Like,
right.
This is designed to circumvent ownership rules. Like, how could this be accepted, right? So
Sure.
There's always that risk when, let's say, China goes into a state of war against Taiwan, limited war, these things are the first things on the chopping block, probably, to exact, pressure. Huge losses on American investors.
Well, there's a lot of herding, and there's a lot of sophisticated investors who have looked this risk straight in the eye and said, yeah, we don't care. We still want to participate in Chinese stocks, right? Like, name your institution. It's quite likely that they have exposure to these VIEs in the same way that a retail index fund investor does, for better or for worse. So there's some, like, I don't know what to call that, just like crowding. It's not crowding, but it's knowing that there's probably sophisticated shareholders investing next to you. But to your point, I think I just checked it out. The Vanguard VT's ETF, which tracks, I think, MSCI FTSE Global All Cap Index, only has at present 4.4% allocated to Chinese stocks. So if you're an index investor and you're saying, look, I just want a simple global market portfolio, that's where I always go. I always stick the VT ETF. If you were to exclude China and build a portfolio that says, I don't want these VIEs, 4.4% difference from the global portfolios, I just don't think your tracking error is going to be that big. I think this is probably an area where most US-based investors probably have not massive limited exposure, just based on the simple rules that exist today for index investors. But if it's something you're really concerned about, or if you're quite allocated to China for whatever set of reasons, this is something you definitely need to dive into and understand.
Yeah. So I think also the big question mark will arise when some of these companies want to start paying dividends, right? Because typically speaking, dividends are withheld 10% if it flows into a domestic entity from China. And I believe it should be withheld 20% if it's foreign. Again, you're at odds here with Chinese law. If you are dispersing a lot of dividends to foreign people and then suddenly you're not supposed to have foreign investors, it just does not, there's like things that are going to crash into each other, like two different rules. So you have a lot of things that are building up. Rules are not that are they don't mesh together. And so I think eventually this will resolve, but it's a non-zero risk. And I think at that point, what you're going to see is a constant, if you had the same company in China and in the US, they would trade at different multiples. And I think that's what you're going to end up seeing, is that Chinese tech and stock will trade at a substantial discount to US tech. And we've seen it over time. It kind of in the last 2 years, it actually shrunk, and then now it's expanding again. And the Chinese tech market has been in a bear market for, I don't know, a year now, a year and a half. And this last 2 weeks have compounded the difficulty, because they don't, I think American investors do not see rule of law being strong in China.
If the Chinese government in particular didn't like the initial setup of the VIE, they would have clamped down and like they have enough control and visibility. They would have done that earlier. But you're right that it's a tool in their toolbox to cut off, right? A strategic tool that they could change at any time. So it makes sense on the front end why they would say, yeah, we're actually okay with this structure and raising money from foreign investors and dollars flowing into China. But on the back end, it does leave them with a lot more power to say, yeah, this is gone. This doesn't actually, all these VIEs don't actually represent anything, legal right to anything in China. That's just wiped out. That definitely makes sense. Also, a fun piece of context, former SEC chair, Jay Clayton, kind of a white shoe, very expensive lawyer, helped take several Chinese tech giants public. So this has gone, like, this structure has been functionally rubber stamped by the highest levels of functionaries in the US government, the best lawyers, right? They did their best to make this structure work, but that doesn't mean that's like functionally meaningless for exactly the type of risk you're talking about, right? Like Jay Clayton being involved doesn't change the CCP's strategic needs for future capital controls.
I don't think the US will limit the investments into the VIEs, they might give some warning, or I don't think that's where the limit will come from. I think the pressure will come from the CCP saying, so the Chinese Communist Party saying like, we don't want more of these entities listed in the Cayman or like in the US market. We want them to be listed in Hong Kong. And so they will start to pressure companies to start delisting and relisting in Hong Kong. And their main reason why they want that is because they're subject to audits. If they're listed in the New York Stock Exchange, or not even the New York Stock Exchange, and the other exchanges, they're subject to audits. You need to have audits. And so I don't think the Chinese government is very happy to have
audits, nor to be held to the same, whatever FASB accounting standards. Death is an event, is like a saleable, or well, kind of a not a saleable event in current terms. So
what does that mean?
Your parents own a house. They paid $500,000 for it. It's worth $2 million now. If they leave it to you, they both pass away and they leave it to you, with a step up in basis, what that means is the $500,000 that they paid for it and the depreciation that they took on it doesn't matter at all. It goes away. Your basis, your cost basis, is as if you paid $2 million for that house on their death. So that's a big step up. That means if you sell it right away, you don't have a taxable gain. You're not worried about that $1.5 million that they would have been worried about in taxable unrealized gains. It's a big advantage of dying, death and taxes. You get a step up in basis. It's a huge planning tool. People use it all over the place. Eliminating it makes death a much more taxable event for many, many more people than it would be now. So it's like a total game changer of what estate planning means, how you need to think about it, and the liquidity needed. It's probably a boon for the life insurance industry, actually, because liquidity is going to be so much more necessary at the time of death than it would have been before. Like if you're inheriting a liquid assets, this is a huge deal. If you're going to inherit a business, a farm, real estate, name other illiquid stuff, that's a big deal.
The world of taxes, there's actually like two big taxes, if you're looking at planning for, post your death. You have income taxes and estate taxes, and they're different, and they're different. So like the income tax applies in some places and the estate tax applies in some cases. So the income tax applies during your life when you have income. And when you died, on the income generated of those assets that you have in your estate. So when you pass away, if you don't have a trust or anything, most of your assets go into the estate of your name. And then it can generate income, and you have to pay income taxes on that. But when you pass away, you don't pay income tax on like the sale of the stock afterwards. I think your estate, if they get that step of basis that what you were explaining, is that they get it automatically, and it's an amazing tool. So what you do pay is when you hit the estate is, if you're above 11 million right now, you start paying taxes, and the taxes are like 40 or 45%. I forget what it is, but it's like anything above that, you pay 40% of the value. So you don't get, let's say you have $1 million above the estate exemption limit. Your heirs don't get that million; they get 600,000, or I think 650. I don't forget what exactly the amount is. It's a big tax, right? But the stuff they get there afterwards, they can sell it, and they don't have to pay income tax right away unless the value after they get it goes up. So let's say, as you said, you got the house that the parents bought for $500,000. It's worth $2 million now. It's below the state limit, and so there's no estate tax on that. And then when you get it, you can sell it for $2 million. You don't pay taxes. So tax-free asset. It's a great planning tool. If you put it in a trust, though, and this is one of the issues, people say, "Oh, I'm going to use a trust." If you put it in a trust, you don't get the step up in basis. because they transfer it to a trust. That trust never dies, so they don't get the step up in basis. That's kind of like the rule. What they're talking about, like if you don't get the step up in basis, what's the point of carrying the stuff in the state? You just have to transfer everything to a trust. Period. Trust will be used way more now because you avoid probate, which is the public disclosure of how much your assets are worth and all that other stuff. It just creates like a different type of incentives. And I think if that happens, it will be a boom for all the estate tax planners and a boom for all the estate tax accountants and appraisers and everything else. It will be life insurance. It will be a super duper change. Talking about life insurance, you can actually create like a trust where you actually, gift money to the trust, and that trust now pays for the insurance on your life, and it's out of your state. There's a lot of things you can do to avoid paying the estate tax, but it requires enormous amount of planning and foresight, and most people just don't want to deal with their own deaths, I think, and that's a big, big mistake.
Have you had an influx in just people wanting to connect with you for finance topics over the last 10 days?
Tons. Yeah, I don't know where they're coming from.
This is a weird thing. I'm like weirdly believe in like the phase of the moon or something and just happening. Maybe it's just life happening. It's late July. I guess kids are going back to school, but I have had more inbounds from people that I know or just, I don't know. People want to talk about finance topics in the past 10 days. So if this has been on your mind, it's just been like a funny thing where for the 8 weeks before that, not very much. And then the past 2 weeks been like, wait, everyone wants to talk back to back. Anyway, I had one of those conversations. It was with a good friend who I grew up with. And we had talked finance topics here and there. And he laid out a conversation for me that I really liked. So he's a government employee. He has a government job. His wife's a teacher. He's also in the National Guard. So he's got that extra income and a really strong healthcare backup, right? Being in the military in the U.S. gives you like a really strong baseline of healthcare coverage for you and your family, basically for life. So, what he has is a good bit of savings, steady income, really good job security. Ditto for his wife. They're starting a family. They have a house already that they like and can stay in for a while. They have a ton of financial stability. And they have a ton of predictability because both of their pay raises are on very scheduled, graded things, right? We know where this is going. So the financial stability for income, for their assets, which they don't have a bunch of risk assets. They've got a home and cash, right? They have so much financial stability that the next 10 years you could really dial in and say, this is where this is going to end up, right? That like the stability levels are off the charts. Very, very high. They're both healthy, right? That's just a ton of stability in the system. And he called and pointed this out to me. I didn't come up with that insight. And he's like, yeah, we need to shake this up. And I'm like, I haven't had anyone just come and like tell me that they need to expand the range of outcomes rather than constrain it. Most of the clients I work with we're working to constrain the range of outcomes to something that they're comfortable with, right? But this was a case where expanding the range of outcomes was critical. And that just got me thinking about volatility seeking in general. I think like broad finance theory would tell you that you probably can't have high expected returns in anything without significant volatility. Ipso facto, volatility should be a good thing and should be sought out. Not necessarily as like, oh, I only want to own the most volatile stuff, micro caps or cryptocurrency or whatever it is. You can take that principle too far. But I don't know. It's just on my mind. Volatility seeking can be good. I definitely engage in it. And I think it also explains a lot about the market that we've been in, like post-COVID. Matt Levine's boredom markets hypothesis was that everyone is bored at home. Robinhood is very easy to download, very easy to fund from your bank account, which was full of stimulus money. boredom at work, if you're working from home, like people wanted to add volatility. Like, yeah, I want to buy calls on some crap stock to just see what's happening, right? Let's shake
Yeah.
this up. Let's shake up the range of outcomes. So those like, I don't know, few things just started to click for me that volatility seeking is not always incorrect, and sometimes should be sought out.
What amount of volatility? How do you actually figure out like who deserves how much volatility? Who's recommended?
That's the art, man. That's really really hard to determine who deserves what, and it's hard to give people as well a good sense of where they stand on kind of a personal volatility scale compared to someone else. I don't think there's like a perfect measure of it. You can measure the assets on the balance sheet, right? Like, do you own only cash and bonds and a personal home and have very stable jobs? You're going to be really on the stable side of potential outcomes. And or do you work at a startup with a ton of options, and what else would be, and own a side business, and don't own a home, and have a ton of cryptocurrency and random other stock options, and a very volatile portfolio, right? It's volatility on the income side, volatility on the personal side. I think people intuitively understand it. They may not say this out loud, but people intuitively understand this. Like, people choose careers probably when they're evaluating it that fit their preference on this, right? People become physicians to lower vol of like career volatility, right? Like, it's just not going to be that volatile likely for most physicians, because there's going to be demand for it. You're going to make a high income. Like, you kind of just, you know, the outcome there. I think healthcare in general kind of fits that bill. And then people become entrepreneurs or, you know, seek volatility in the career side for other paths.
I have this theory, and we can develop it here, but I think each salary should have a beta, or like
Beta.
some sort of the beta of your salary, right? So, you're a employed person in the space of catering. Your beta is high, right? You work in healthcare, you're a physician, your beta is damn low, right? So if you actually include the salary as a fixed income payment as a portfolio, like where you have, like bonds, they have fixed income, right, every month, and that reduces the volatility of the portfolio. If you think about your income is technically a quasi fixed income note, right? So like if you get, I don't know, $10,000 a month, right? That's $120,000 a year. And so if you divide that by, I don't know, 5%, and why 5%? Because that's the risk attributed to your salary, right? Then, you technically have and you assume that that's kind of like permanent going forward.
In
You assume that
perpetuity.
perpetuity, yeah, or maybe for the next 30 years, right? And so you can actually calculate what's the value of that income stream. And you can add that as a portfolio asset. And then really hone in on the actual, I would say, volatility of your entire, future income assets, all of that together. I think that is the correct way. We actually only look at your savings portion, but technically speaking, if you include your salary, you get a much better picture of what the volatility should be. And I think that's the missing link here.
I'm with you. We can rewrite all of financial planning based on income vol and do like way better Monte Carlo. That philosophically totally makes sense to me. It takes me a million different places. One of which is I've complained to a bunch of software providers about this. On the institutional side, if you work with MSCI or S&P or a ton of different institutional investors, they're going to ask you always to provide deep volatility data on portfolios, right? On any little sliver, so that they can run correlations and try to figure out in these complicated risk management scenarios what's going on. Most investors, and frankly most RIAs, don't have a great way to manage actual realized volatility of portfolios. Not manage, measure is what I mean specifically. So like measured volatility, you and I have talked about this. So I know you care about this a lot, but measured volatility is a massive thing. And you could get data points and go month to month on a client by client basis and measure the volatility of their income, right? That's totally a measure. That's like a data point that could definitely be included here. So future finance, bookmark this 10 years in the future, maybe we'll be measuring income vol and deciding someone's like overall vol stability there. Government employees, doctors will be on the low side.
Yeah, of course.
Salespeople, entrepreneurs will be on the insane side.
On the higher side. And so then, your I would say the probability, like your investment strategy should change a little bit, right? Because this is a huge asset if you think about it, right?
It's the asset.
If you actually,
for young people, it's the asset.
Yeah. And so if you have, I just think it changes a lot, and people don't realize that they have a fixed income portion. When there's a lot of volatility, certain assets decrease in value. Obviously that's natural. Like if you don't want to buy a volatile asset, you want to buy a safe asset. And so inherently an asset that's temporarily more volatile than another will price at a lower amount. But volatility is dynamic. Volatility isn't permanent. And so if you have a different perspective on volatility, then you might have an edge in investments. And so, for example, I'll give you an example. Lumber was incredibly volatile a couple of weeks ago, or a couple of months ago, and the price was a little bit different. It went on the upside, right? It was volatile, and I think the volatility it's coming down, and as a result, I'm not gonna say it's worth more, but it's the stability of it. It's more helpful to have it stable.
Agreed. I'm also going to share a screenshot that I took today. Everyone knows who this guy is, Nassim Taleb. This is a thread where he's talking about volatility, what's risky and why. He was talking about Bitcoin earlier and how he's not a Bitcoin fan anyway. Someone asked him about this, like, hey, when's the crash coming, or what's going to crash? I love this. He thinks that the more something is perceived as stable, the worse the fall. So the lack of vol may be begetting future vol. This gets into the weird, like, snake eating its tail stuff that you'll read from a lot of volatility guys. But I thought this was interesting where, Bitcoin right now is super incredibly volatile. That is what it is. In this philosopher's mind, Bitcoin being volatile in itself is sort of a safety feature, right? The fact that it's volatile and everyone knows it's volatile. I mean, there's not a perception of safety, which I totally agree with. I don't think anyone would perceive, well, actually, there's some hardcore super Bitcoiners who think Bitcoin is safety. But that's not a widely held view of that market. But he thinks real estate is the one where people perceive safety, and stocks are there too. I'm not saying I agree with this at all. I just think it's a interesting framing for vol begetting vol, or lack of vol begetting future vol.